While everyone chases the flashy artificial intelligence names, most investors are ignoring one of the cheapest artificial intelligence powerhouses in the market. Dell, the company most people still think of for PCs, also sells servers powering the artificial intelligence revolution. It trades at under 16 times earnings and returns nearly every dollar of free cash flow to shareholders. In this video, I'll show you why the company building the backbone of artificial intelligence might also be the safest way to play it. Dell isn't just a computer brand. It's one of the largest technology infrastructure providers in the world. Beyond the laptops and desktops most people know Dell for, Dell also builds servers, storage systems, and networking gear that power data centers globally. For decades, Dell has been a top supplier to enterprises, governments, and cloud providers, the ones running the digital backbone of the internet. Today, the same infrastructure business is being transformed by artificial intelligence. Every new artificial intelligence model, every training cluster, and every data center expansion needs massive compute power, and that's exactly what Dell sells. In fact, Dell is the number one provider in both compute and storage, and they've held that lead for decades. So while most investors still think of Dell as PCs, they are quietly supplying the hardware running the world's artificial intelligence workloads. Their systems power everything from corporate data centers to specialized artificial intelligence clouds like CoreWeave and xAI. The artificial intelligence boom is creating an arms race in computing power. Every major company is racing to train, deploy, and run artificial intelligence models, and that requires massive amounts of hardware. GPUs, storage, and networking gear are in short supply, and the companies that can deliver them reliably are in high demand. That's where Dell comes in. While others fight for flashy artificial intelligence headlines, Dell is quietly building what it calls artificial intelligence factories. These are full-stack data center systems designed for training and deploying artificial intelligence at scale. They're already delivering to more than 3,000 enterprise customers with another 6,700 in the pipeline. And now, Dell is the first supplier to deploy Nvidia's GB200 artificial intelligence platform, the most advanced artificial intelligence server chip on the market. That means Dell isn't just shipping hardware, it's trusted by leading chip developers as their first choice provider when new artificial intelligence chips launch. Instead of chasing hyperscalers like Amazon or Google, Dell focuses on Tier 2 cloud providers, sovereign governments, and enterprises. Customers that need artificial intelligence infrastructure but don't have the in-house engineering to build it themselves. Think companies like xAI, CoreWeave, and G42, all of which rely on Dell to spin up massive GPU clusters in record time, sometimes going from dock to deployment in under 36 hours. Dell's business model is built for predictable, profitable growth, not hype. Management expects revenue to grow 7 to 9% annually, driven by ongoing demand for artificial intelligence infrastructure and enterprise data solutions. As margins improve, that should translate into net income growth of roughly 8 to 10% per year. Dell also believes it can convert nearly all of that net income into free cash flow, returning at least 80% of it to shareholders through dividends and buybacks. At around a forward price-to-earnings ratio of 15, returning 80% of earnings equates to around a 5 to 6% cash yield. Add in 8 to 10% annual earnings growth, and total shareholder return could reach 13 to 16% per year. Using a conservative midpoint of 14%, that compounds to roughly a 93% total return over 5 years. This assumes no changes in Dell's valuation multiple. In other words, if the stock simply maintains its current forward price to earnings ratio of about 15, investors could nearly double their money in 5 years purely from earnings growth and cash returns. If you're finding this kind of breakdown useful, tap that like button. It helps more investors see videos that focus on real fundamentals instead of hype. At the Analyst Day, Michael Dell described this approach as a balanced fortress model, growing steadily, managing risk, and returning nearly every dollar of free cash flow to shareholders. It's not about betting on the next big breakthrough, it's about owning the infrastructure behind every breakthrough. My view is simple. Dell is the AI play for investors who don't want to take big risks. Unlike most artificial intelligence names, Dell isn't pouring every dollar into speculative growth. It's returning that money straight to shareholders through buybacks and dividends. That makes it a steady, predictable way to participate in the artificial intelligence build-out without having to guess which chip maker or software platform comes out on top. That said, it's a position that needs to be carefully managed. If the stock's forward price to earnings ratio expands to 20 or higher, the math changes. Dell's long-term returns rely heavily on cash distributions, and as the valuation multiple rises, those buyback and dividend yields become less attractive. For example, if the forward price to earnings ratio expands to 25, the future shareholder returns would fall to around 11% a year if the forward PE holds. If the forward price to earnings ratio subsequently contracts back to normal levels, the return could be even lower. Thus, the position needs to be actively managed. I see Dell as a fortress position, great to own while it's cheap, reliable, and paying you consistently. But if the multiple takes off, it's probably time to lock in profits. Dell is more a financial engineering story than it is a growth story or a cash return story. The play here is holding the stock while the mild future growth and cash yield justify it, and selling if the valuation multiples expand too far. Not blindly buying and holding the stock. It's not a perfect fortress though. There are a few cracks or risks worth watching. One risk is margin pressure. During the Analyst Day, Dell explained that artificial intelligence servers currently carry mid-single-digit operating margins below the corporate average due to the high cost of graphics cards and the accelerated infrastructure build-out. However, Dell expects those margins to rise as supply stabilizes, the mix shifts towards enterprise artificial intelligence deployments, and the company adds more services and software. So while short-term profitability on artificial intelligence servers might fluctuate, management sees long-term margins improving as the business scales. Another consideration is Dell's traditional PC and enterprise segment. Even if IT budgets remain steady, much of that spending may not go towards upgrades. Many offices simply don't need to refresh hardware every few years anymore. Most modern systems are already more than capable of handling typical office workloads. So even without an economic slowdown, a shift in IT priorities towards artificial intelligence infrastructure could temporarily cap growth in the legacy PC business. Dell isn't the most exciting artificial intelligence stock, and that's exactly what makes it interesting. While investors chase the next big breakthrough, Dell is quietly building the infrastructure behind every one of them. It's the fortress provider of servers, growing steadily, converting profits directly into free cash flow, and paying nearly all of it back to shareholders. At under 16 times earnings, it's cheap. You're getting stability, scale, and predictable returns. No matter what chip provider succeeds, Dell is positioned to win by being the one that sells the picks and shovels to everyone else. If you stuck around this long, join me on Discord. I'd love to talk more about investing and artificial intelligence with you. Link in the description. Thanks. Bye.